Silver just ended January 2026 with its most violent drop in years. If you watched my video last week, I warned this was coming, but if you think this is just about a shiny metal, you're missing the macro signal. Here is the smoking gun. The CME Group has issued a massive margin hike award. Effective Monday, February 2nd, maintains margins are increasing across the board. We're talking about 33% increase for gold futures and 36% increase for silver futures. But look closer. Platinum is up 25%, palladium is up 14%. When the exchange raises margin requirements by 30% overnight, they're issuing a forced margin call. Traders holding leverage have two choices: wire cash immediately or the exchange liquidates their position, market on open. Most traders are tapped out. They were forced to sell. This is not market manipulation. This is a liquidity vacuum. Now, connect that margin hike to this chart. Global fund manager cash levels have plunged to 3.2%. This is the lowest level in history, lower than 2007 peak, lower than pre-COVID 2020. Do you see the problem? Everyone is owing. There is no cash on the sidelines to buy the dip. When forced sellers hit a market with no buyers, prices do not slide, they flush down. Now, I know the counter argument. You're looking at the Shanghai Premium hitting a record $29 Aussie and thinking China will save the price. Listen to me, that arbitrage window is closed for retail. While the East is buying physical, and it's true, the Western paper market sets the spot price for leverage. If New York and London liquidate, Shanghai will happily wait and buy it cheaper, but which market is leading right now? Do not underestimate the power of New York and London in the short term. And for the bulls screaming physical shortage, look at the lease rates. They were normalizing and the trend was going back to zero. That massive backwardation that was squeezing the shorts last month, it is still there, but it's disappearing. When lease rates crash, it means the desperate bid for immediate physical delivery is gone. The coiled spring tension has left the market. We are losing the fundamental backstop exactly at the moment the technicals are breaking down. Real quick, the algorithm hates real data. It wants to feed you to the moon hype. If you want unfiltered financial intelligence that actually prepares you for volatility, hit subscribe and turn on notification. I will tell you what may happen before the crowd panics. Now let's look at the engine driving this bus off the cliff, the US dollar. Why is liquidity drying up? It starts with the news that Kevin Warsh is the nominee for Fed chair. The market knows Warsh is a hawk. He believes in positive real yields. He hates financial repression. The bond market is pricing in higher for longer rates immediately, and that is disaster for the crowded trade. Look at this positioning data. Dollar shorts are at record levels. The entire world, hedge funds, emerging markets, corporates, bet on a weaker dollar for 2026. Here are the mechanics of the crash. Warsh scares the bond market. Yields rise or expectations for lower rates fade quickly. The dollar rallies and those record dollar shorts get squeezed. When the world rushes to cover dollar shorts, they have to sell any assets to buy dollars. They sell silver, they sell Bitcoin, they sell stocks. We are staring at a dash for cash scenario similar to March 2020. If the DXY breaks 101, it is game over for risk assets in the short term. It is not just metals, the stock market is sitting on a pile of dynamite. US margin debt hit a record $1.23 trillion in December. It had risen for 8 straight months. But here is the divergence. Margin debt is growing 20% faster than the S&P 500 itself. This means The rally is fueled entirely by borrowed money. They are betting on a weaker dollar. Bank of America's buy and bear indicator is at 9.2. That is a maximum sell signal. The last time we were here was January 2018, right before Volmageddon crashed the market 12% in 2 weeks. And don't think China will save us. Chinese emerging financing just hit $390 billion, surpassing the 2015 bubble peak. The entire global financial system is leveraged to the hilt. So if the system is flushing, where do you hide? You stay prepared with cash. Look at the crude oil to silver ratio. While the crowd chased ice, stocks and metals, oil was left for dead. It is mathematically the cheapest real asset on the board. Oil reflects the real economy. If this dollar squeeze breaks things, geopolitics will likely flare up again as nations fight for resources. Energy is the hedge nobody owns. But let's zoom out to the endgame. Despite this short-term deflationary force, the US government must refinance 25% of its debt in the next 12 months. We are running a $2 trillion deficit. But keep in mind the Fed is currently buying $55 billion in treasuries a week behind the scenes. Markets will be volatile next week, so be very careful. Next 72 hours are a liquidity test. Watch the dollar index. If it spikes, it means that it is better to stay in cash. Let the leveraged traders get wiped out. I've seen this many times in my 15 years investing career. So we are waiting for the VIX to spike and margin depth to reset. That is when generational wealth is made, buying from forced sellers. The situation is fluid. If the dollar index crosses 101 to 106, I will be posting an emergency update, connecting the dots. So do not be the last person to know, and click the circle to subscribe and hit the bell so you get the alert the second it drops. I'll see you on the next one.